You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.
And now, it's time for the show that breaks down the options market, from unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tussaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
And hello, everybody, and welcome to the Option Block. This is your show for options education, witty banner, all kinds of stuff, everything related to options. It is your bi-weekly source for options news and information. It is I, Andrew Giovinazzi, the Rock Lobster, beaming in live from where else? The hinterlands of Maine. I say that just for Longo. Oh, who, by the way, apparently is in Florida working with Sebastian. They're spending the week in Florida working at the CBOE Risk Conference. So you take that to mean whatever it's going to be. We do have an interesting show for you today. We're going to do something a little different since we don't have Longo here or Sebastian. So I'm going to talk about butterflies during our strategy block, what makes a butterfly sort of take off, the differences between near the money flies and out of the money flies, and also when a fly is really a bad and dopey trade and when it's a good trade. There's some nuance there, and I thought we'd cover that a little bit. Brian is pretty good with strategy, so when he pops in for the strategy block, I thought that would be a good way for us to discuss what's going on. So let's head now to and with that, I think I got all the intros pushed out there, and for our next segment, let's take a look and see what happened today. Trading, we're going to go to the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading
And everybody,
Block.
welcome to the Trading Block. This is the part of the show where usually Longo, Tussaw, myself, and Sebastian will talk about what happened today, but I get to talk about it all by myself. And what did happen today? Well, after, 4 or 5 days of rallying, we continue to rally. And I think it's a little bit of relief rally. Basically, all the things that have not come to pass, all, I guess, the really bad stuff that everybody was expecting really hasn't happened. Don't know if it's going to happen in the future. But all I know is that VIX is now in the 16 handle, which I didn't think was going to happen prior to the non-farm payroll number. Thankfully, I gave myself a little room in the opposite direction. But we do have a VIX trading 1670s, trading the low of the year. We have huge contango in the futures, meaning the future premium over VIX is pretty darn expensive. So what usually happens with that is when the market gets into what we'll call more benign territory for volatility, meaning the volatility starts to get to the teens, and volatility in the options starts to bleed out. So VIX volatility is the lowest it's been since July or June. We haven't seen volatility in the 70s in VIX in a long time. And normally VIX works when VIX is going up or the expectation going up, volatility gets really pumped in there. Only 2 weeks ago it was about in the 120s. So massive, massive change in premium in VIX options. I don't know who blew the all clear signal, but somebody clearly blew the all clear signal, and I'm still looking for the whistleblower on all of that. But it still worked out okay, and at least at this, and part of what I'm seeing is we're getting new snippets. If you're looking at a lot of, so something that's been a little bit interesting in the chat room for us at Option Pit was all these kind of oil and gas exploration companies, energy producers that were highly leveraged. It looks like some of them are getting some notices as far as instead of going bankrupt, they might get some extensions, changing some credit terms, basically trying to wait out this low oil pricing until they can start making more regular payments. Obviously, this makes a big difference in the equity of some of these companies. So there's like a little junky ones like UPL and Whiting Petroleum, Chesapeake Energy. We'll talk about that in a second separately. But all these, I got positions in some of these, by the way, have bounced off the bottom very hard on expectation of, maybe they're going to get some more favorable credit terms to roll things out. And I think that takes all of a sudden, if there's less worries about credit in the oil and gas space, now there's less worries about bank solvency, and now there's a lot less worries about junk bonds, and all of that stuff. Sort of the cycle that was cycling us down in January and February now starts to cycle us back up, if that is in fact the case. So we're seeing markdowns and volatility everywhere, but in that actually beaten down oil and gas space. The only vol I saw really up consistently was in that area today, amazingly enough. So they're buying options there, and they took volatility down pretty much in everything else, including the name indexes. So it was one of those days where on the surface, if you looked at the SPX and the Qs only let down less than 0.2%. You're saying, it wasn't really much of a day. But in certain parts of the market, it was a very big day. So I think there was a bit of a cage match and fight in the junk stocks as some of the squeezes got pretty hard, and we'll cover one of those squeezes in the odd block today, which is just symptomatic of the things that are happening in that area. So I thought, again, interesting stuff. And definitely it could be a bit of a game changer if that part of the market, if oil and gas in general has found some sort of bottom. We've been looking for the bottom for a year, hasn't really hit yet, but maybe it has come and went and start ripping on the other side. A couple of other topics for us today. We've got volume reported by the CBOE, which, of course, one of my old home exchanges. Still got a fond place in my heart for that exchange. And they're saying volume was around 90. Oh, my gosh, this is huge. 92.9 million contracts. Just reporting that total trading in February. It's an increase in 5% from 2015. But a decrease in 10% from January 2016. So February slowed down a little bit from that very, very busy time. I can also remember when I started, volume on the PCX was 100,000 contracts a day. So what is that? That's 2 million contracts for the month. So the CBOE doing a factorial above that. And 100,000 contracts, by the way, was a busy day back then. So I guess in general, the trend for volume, January was busy, February is a little slower. And I think that goes to the fact that February was extremely volatile. And generally, you'd think that volatility makes us trade a lot more. It actually gets people to kind of sit on the sidelines just a little bit. They're not as active because things are less directional, and that's what I think the volume numbers are sort of playing out for us. But overall, though, as we get a little bit more information, so CBOE volume down a little bit, but we got a little bit of a bump. It looks like from the OCC a little bit of bump in contract volume. So the CBOE volume went down, but it looks like they did marginally a little. Oh, okay, sorry. That was from February 2015. I'm looking at my notes even backwards. So February 2016 volume was a little bit busier than last year at the same time. So anyway, overall, it says that the option volume is still fairly healthy. Now, if Alex were here, we would banter about the CME and the ICE wanting to buy the London Stock Exchange. And to be honest, since they're buying so many exchanges, I don't know why anybody would want to buy another one. You could just go make your own, apparently, these days. It seems like it's that easy to build an exchange. So I find it odd in the extreme, but, I guess the LSE has some marquee products that somebody could be interested in. And, the CME obviously is one of the big daddies in the exchange space. So, and they are, and they're in a grudge match with the ICE over growth. So, and another possibility because the ICE did buy the New York Stock Exchange. I think the CME is looking for a bigger footprint in equities as well. So, it would make sense anyway. And the last thing are seeing is we could discuss yet about what the British exit might look. So there's a couple of things for the calendar for you. March 10th, I believe, Mario Draghi is going to have his ECB, their kind of equivalent of the Fed, and what they're going to do with, are they going to do more easing? They're going to do more bond buying, whatever the heck they're going to do. And I think that could have a huge impact on the euro, especially with a good non-farm payroll report tomorrow, which we'll discuss in around the block at the end. But it's kind of setting up for I think the continued decline of the euro and sort of as the dollar becomes more ascendant. But we'll see if that keeps going. But having Britain leave and maybe some of the others, I can't imagine that's going to be good for euro. And that's still going to contribute to some market volatility. However, like I said, if you look at VIX could care less whether the British exit the euro right now. So I tend to look at how we trade, how the SPX looks at kind of global events and consumes it or subsumes it into the volatility number. I think it's a good way to sort of see the pulse of what's going on in the macro world when you look at the VIX. All right, and with that, I think that covers just about some of the big topics I wanted to hit today on the trading block. Now it's time for the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
Okay, everybody, and welcome to the Odd Block. This is the portion of the show where we break down the large, unusual, sometimes head-scratching volume that goes ripping through the options market on a particular day. I have the honor of doing this, just by myself, because Longo is again in Florida having a grand old time. He says he's working. Okay, he says he's working, but he lives in Chicago and he's going to Florida in March. So you tell me what working really is. However, that's what you get when you run the radio conglomerate. So anyway, we'll look at puts in CHK today, which is Chesapeake Energy. A kind of a sad note for the company. The founder of the company, what's Aubrey McClendon, if I'm pronouncing his name right, died in a car accident, I believe yesterday, after learning he was going to be indicted for some bid rigging while he was at CHK. It's kind of a sad note. To somebody who built kind of a big company. He was sort of the pioneer of fracking in the U.S. as well, so it's kind of a lightning rod. But be that as it may, CHK, I guess, took the news in stride. It was up almost $1 today to $4.12. It is at the lower end of the 52-week range, however, as there was bankruptcy scares only a couple weeks ago. So the trade we looked at in CHK is paper bought the 1,200 of the Jan 2017 A puts for 555. The ADV is around 85,000 contracts, but the open interest on this strike is 74,000 contracts. So the trade went up in a block. So it's a couple of things about it. It went up around $1.40 over parity. So, think about this. You want to pay $1.40 for the Jan 2017 8 call when the stock is only $4. Well, it's not something I really want to do. If CHK gets back up to the teens, obviously it would be a nice thing, but it looks like for a company that just looked like it was going into bankruptcy, that would be tough. So someone either closed a short put, I guess they sold a put within the last week or two, or they're trying to buy a put and replace stock that they were short and is now being called away. So CHK right now, it looks like it's going through a pretty heavy short squeeze, like I mentioned in the trading block. And this would be a way for a trader to get out of the short stock and get into some long puts. However, the effective price of the puts is basically selling stock at $245. So if you're buying the puts to short the stock, they're taking $555 in risk to make $2.45. So I guess if you think it's going bankrupt, it's okay. Or if maybe you're trying to scoop up some of the cheap bonds and you're using this as a hedge, it's certainly I can see you doing that. But risk reward wise for the 8 puts does not look tremendously good at this point. So we'll look at the open interest and see where that is tomorrow. The next trade again could be we'll call this the two-saw trade. It was the trade was in the TLT, which is the iShares Barclays 20-year Treasury ETF. The TLT was up. It was almost about $1 today to 90 cents to 129.86 as we wrote this. TLT is up near the upper end of the range. And I see paper trading 15,000 TLT SEP 10, 110.18 put spreads for 93 cents. The TLT has been very busy this year, trading around 71,000 contracts a day. In this particular trade, there was 15,000 open on the 110s, surprise, and there was only 265 contracts open on the 118s. So what it looks like is paper bought and closed the 110 puts they were short, and they went and sold the 118 puts to, again, it's kind of a line in the sand trade. I'm going to sell the 118 puts. I'm going to collect, they collected 93 cents on the roll. And they're making a bet that, or they'll take TLT down to that area at 118. If not, they just keep the premium. And you got to think about it. What's the return on, the 93 cents out to that time? It's not really a great return on risk. Where's the TLT going? Probably not. I can't see it going too much below like 115. So the real risk in TLT, it's not like it's going to go to zero. At least hopefully not, because that would be the end of Western civilization, I guess. But at least at this point, they're looking to try to generate some kind of income by selling this out of the money put, and would put them into TLT at around the 118, 117 area. Third, this was a head-scratching trade, but again, it's related to all the activity in the oil and gas space. This is in BWP. This is Boardwalk Pipeline Partners. Now, we've seen trades in this name in here before. Specifically, this company had some problems, and as I recall, there was size call buyers in here at around the 8-9 level about a year and a half ago, and they actually rolled them all the way up and did very well. In this case, the paper today, the two big blocks, 1,872 of the BWP March 12 calls trade looked buying, and 846 of the March 13 puts traded 30 cents looking buying. So at some point, it feels like the trader sold both the 12 call and the 13 put, again, looking for premium. It's very possible it was against a long stock position. They were long stock and trying to sell options against it. We don't know. I don't know for sure about the stock part. I'm just speculating. However, since BWP is now trading 1361, the 12 calls are in the money, and they're covering them. So the open interest on the calls was 3,600, and the puts was 9,200. So, in the way I look at that is, if they had stock against it and they don't want to lose the stock, they would be covering. They would be covering the short call, and also they're covering the put for 30 cents. So, again, depending on where they put the trade on, but $2 is a pretty good amount for that strangle. So I can't see them making a ton of money on the strangle. However, if they sold the 12 calls for, let's say, 85 cents and the 13 puts for $1.50, then that's $2.30 on the strangle, and they actually made some money on it against the stock. So it looked like kind of an aggressive play, but because BWP was lower in price, most likely when they put the trade on, it actually was a much longer delta trade at the beginning, and they just want to close it while they're up money. That's how I see that. So when you see something like that, again, the large customer who had the short contracts on, they're looking at that and they're like, I'm going to cover my short calls. I'm going to take the money I have now just in case the squeeze in all these pipeline companies and all these drillers, whatever, at least in this particular stock, does not continue. So to me, it looks like a little bit bullish of a cover. They don't want to get tapped if BWP continues its move back up. And with that, that will do it for the odd block. It wraps up this part of the show, and we are going to dive right in to a special edition of the strategy block.
It's time to dispense options wit, wisdom, and education. It's time for the Strategy Block.
All right, everybody. Welcome to the Strategy Block. This is my first ever Strategy Block, I think. Usually Tusaw puts on the smoking jacket, and he discusses strategery from his high level over there at RCM Wealth Advisors. Here, I'm going to talk a little bit more speculative type of trading for this. So for anybody listening to this, this is definitely for people that are more trading options. And again, any type of option trade like this, you got to think a little bit about how much money, make sure you understand risk control, make sure you understand how these trades operate. But I thought we're going to talk about a butterfly in this case. So basically there's two kinds of butterflies in my mind. There are the standard fly. So the nomenclature for me is a long butterfly. Whatever you do with the wings is what you do with the fly. So if you're long a butterfly, you're long the wings, and you're short the body in the middle. So the first part is you got to decide whether you're long the fly, right? Meaning you're long the wings and short the options in the middle. You want the underlying to go to wherever the short options are, right? That's generally when you sell options, that's what you want. You want the underlying to go there and stay. A short butterfly is when you're long the body in the middle and you're short the tails. So when you're short the tails, you want the underlying to move out to the tails. So long flies actually want the underlying to go to the short strike, and short butterflies want the underlying to go to sort of the out of the money strikes. So they're two totally different types of trades. So what we are going to talk about here today, though, we're just going to stick with the long fly trade for right now. Funny enough, this has been a very difficult market for certain types of butterflies. Why? Because the market's moving a lot. So when you look at a butterfly, there's a couple things that you want to do. First is you have to separate, is it a near the money fly or an out of the money fly? So if you buy a butterfly and you're selling the strike wherever the stock is right now, I'm going to call that a near the money butterfly or a slightly in the money butterfly. When you put a trade on like that, you're essentially saying, I don't want the underlying to move. When you have a market like this, when the SPX was, I think, 1900 only 7 days ago, and today it's 1993. A long butterfly actually is a very difficult trade because it's going to run right out of the wings of the fly. What you want them to do is to stay inside the wings. So a very difficult trade in an environment where everything is going straight up. So what you do is you kind of change polarity and say, well, the at-the-money fly is not working so good, so maybe an out-of-the-money fly would be better. So what you do is you take your butterfly and you aim it to where you think the underlying might go. And why butterflies are popular is it cuts down the money of the long strike tremendously. So when I set up a long out-of-the-money fly, I put the short strike somewhere where I think the underlying is going to go. And what I do to help me actually price that is you take the at-the-money straddle, and that's what usually what the at-the-money straddle tells you is that's what the expectation for one standard deviation of movement is, roughly about one straddle. So you take your flies and you decide to place them around that one standard deviation. So if you really think the stock's going to take off, you're going to push it a little bit to the outer end of the straddle, or to the outer end of the straddle price. So if you got a $5 straddle price, you want to put your long fly more like $4 away from the money, something like that, because you're assuming a move in a particular direction. So what that does is that helps you sort of aim your flies or aim the trade where you think the underlying is going to go. Now here's a couple of just simple tips about flies in general. When are they bad? Butterflies are bad when the market's moving all over the place. Okay? Anything near the money, very tough to trade, right? Very tough to make any money because just the underlying volatility is so high, the butterfly never will pay for you, right? Because you just keep running right outside of it. So if a near the money fly is bad, then flies that are more out of the money are good, because those are going to gain in value as the underlying moves toward that center strike. So when you have low vol, you kind of want your fly near the money. When you have higher realized vol, you want to place your flies farther out of the money, and they will actually perform. And if you follow those simple tips or simple ideas on how to structure flies, you'll probably do a lot better. Also, make most of your fly pricing, use one standard deviation, and that will help you decide, really what is realistic for a fly. Because remember, the whole idea of the at-the-money straddle is that's the best guess on how much the underlying is going to move for a particular time frame. So use that as a pricing mechanism to help you kind of place where your flies are going to go. And with that, I'm going to close the rapid fire strategy block off and move right into, I guess, an abbreviated version of everybody's favorite segment, the mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail
And hello,
Block.
everybody, and welcome to the Mail Block. It is I, again, Andrew Giovinazzi, with the hosting duties, as we cover one letter here, maybe two, and we'll see what everybody has to say here. But keep all the, I was going to say cards and letters coming, but nobody sends cards and letters. Keeps putting stuff into Twitter, and all of I think the Options Insider Radio Network is connected to every possible social media outlet there is on the planet. So they have something for you. Okay, so first question from Adam. Thank you for your shows. I'm wondering if you know where I can get put call ratio and call sizzle index and out sizzle index history. I use TOS, but this isn't available for the past. Thanks. You know what? That's a great question, Adam. The only thing I can think of is in TOS, if you go into the swim lessons room and ask those guys if they have any history on that stuff. I myself really can't think of any place, but what I will tell you is a good proxy for sizzle and stuff like that is looking at realized vol. And in TOS, you can use they have a historical volatility chart that will give you at least some idea when the underlying is really busy, or you could look at implied volatility chart and see when the implied volatility was a little bit more active than normal. That might help, but I don't know of any more historical sizzle index information. But that'd probably be good. That'd be a nice chart for Toss to ask. So just you should just ask those guys. And let me see here. Is there one more question here? I like this one. I'll just take this question really fast. Is there a directional option strategy that you would suggest for someone who wants to play the 2016 election? Generally, what happens into the election is volatility rises. So as you get closer to the election, you could look at some sort of long Vegas strategy. Probably, maybe you start to look at it in maybe September, October. My guess is it's going to be a lot like an earnings cycle where, you have you get kind of a run up in volatility, and basically you'll probably get some, let's just call it reduced theta up into the election. Now, I do remember 2012 election, the market tanked pretty bad after the president got elected, then it bounced right back again. So that could be if this election, it might give us the same type of result. We don't know. But in general, you should see a bid for volatility into the election. And with that, that will close this edition of the Mail Block. And we will go to Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, everybody, welcome to Around the Block. This is where I will poll and talk to all of our hosts and ask them, what are you looking at? And really right now, all I can do is talk to me. So I'll say, what am I looking at? I think the big changer, or the big game changer, will be if the oil and gas industry can pull out of its slump, if the talk about OPEC cutting production and all the production cuts, and there could be real restructuring of all this debt and all these bonds, if that can kind of happen in some sort of smooth fashion, I think that was a big part of what's been dragging the market down. And I think that could be extremely bullish, certainly for some of the equities, maybe some of the ETFs in that space. Could be very interesting trading as far as that this week. So I'd like to see more news about it this week. But of course, the non-farm payroll number. We've had a huge rally, and we've totally destroyed volatility prior to the number, which is either everybody's right and the number's not going to matter, and the ADP number was pretty good. It showed solid job growth. I guess nobody else has solid job growth but the U.S. But again, that's good for the U.S., and they pre-crushed the volatility. So if the number's what the market's expecting, I think the stocks are pretty much pre-bought for it. But I would not surprise me to see 2,000 at all. I actually kind of expect us to at least to touch that. And if so, it wouldn't surprise me at all either to see VIX drop below 16. So those would be the two biggest things that I'm looking for on Friday. And with that, I will close Around the Block, and we will get into what's happening with everybody here, at least for me. I know we are going to be doing an advanced directional calendar section, basically for diagonal calendars at Option Block. You'll see a note for it in March. And for anything else, you can just run to our store. And if you want to learn about volatility or anything else, you just go pick it up right there. And with that, with myself, I'll say goodbye to myself. I'll say goodbye to you. And that concludes this Thursday, March 3rd edition of the Option Block. And I will see you all next week.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.